My dear friends and investors, welcome to the new financial year's first communication on markets and investing. Well, this month is going to be completely dedicated to just one topic: tariffs, tariffs, and tariffs. Every world leader, every economy is today highly focused on how they should handle the new Trump tariff and trade policies which were announced on April 2. While this was anticipated, I think what took everybody by surprise was the intensity of the tariffs and the breadth of countries that were covered. And dear friends, this definitely has a significant implications for the global economy and the markets. So let's delve into the details and try and understand what disruptions can these new trade and tariff policies cause to India in specific, what can be our mitigating strategies, and therefore how should investors interpret and react to these very epochal events. To begin with, I think if you look at the tariff table which President Trump displayed on April 2, it is very clear that India is somewhere in the middle of the pack. India was slapped with about 26% tariffs on goods that are imported into the US. Yes, there were certain exemptions, but by and large, India was somewhere in the middle of the pack. The real aggressive tariffs were on China. They already had a tariff of 20%, but on top of that, there was an additional 34%. So China tops the league tables with 54% tariffs, followed by Cambodia at 49%, Vietnam at 46%, Sri Lanka at 44%, Bangladesh at 37%, Thailand at 36%, Taiwan at 32%, Indonesia 32%, Switzerland at 31%, South Africa at 30%, Pakistan at 29%, followed by India at 26%. So, one of the things that would be important to note is that really the tariffs are targeted primarily at China. And then there are also some of the smaller countries like Cambodia, Vietnam, Sri Lanka, and you would wonder why tariffs on those countries are significantly higher. And the reason was very simple, that China was using many of these countries as a production base or as a front to export into the US markets. And therefore, to comprehensively target China, the tariffs were also put not only on China directly, but on all other countries which China was using as a production base. One of the interesting aspects of this is that in several items of manufactured goods, many of these countries which have been slapped with much higher tariffs actually compete with India. And therefore, to that extent, India stands relatively far better, and there is a potential for India to take some global market share in the future from some of these countries if these tariffs were to remain at the levels at which they have been indicated on April 2. Now let's look at what is our trade balance with the US. Now, what does trade balance mean? A, how much do we export to the US and how much do we import from the US? Today, India runs actually a trade surplus with the United States, and so do many of these other countries. On the whole, United States runs over a 1 trillion deficit in terms of imports, i.e., what it means is that many countries export more to the US than they import from the US. And what President Trump is trying to do with his new trade and tariff policies is to reduce this gap between America's imports and exports. And primarily, there are two objectives that President Trump is trying to drive at. A, obviously he wants to reduce the trade deficit with their principal trading partners. And secondly, he also wants to encourage manufacturing to come back to the United States. Hence, if we look at specifically India's trade surplus with the US, you will see that in financial year 24, for which data is available, India exported $78 billion worth of goods and services to the United States and imported $42 billion worth of goods and services from America. Therefore, India actually has a $36 billion surplus with the United States. Now, what the US wants to do is to reduce this gap of $36 billion significantly and as much as it is possible. If we were to look at the merchandise exports, and what we mean by merchandise exports is only goods exports, not services, because India also exports, and one of the largest services exports to the US is software services. But for now, we will keep that out. We will only focus on merchandise or manufactured goods. And if you look at that, you will see that out of our total exports of merchandise to the US, it is only 2% of our GDP, right? So if you take our total manufactured exports, and then if you look at that, how much of that do we export to the US? It accounts for just 2% of our GDP. So it's not a very significantly big amount that we should be worried about from a percentage of GDP perspective. And out of all the total manufactured exports that India does, US share is about 17.7%, or roughly 18% of India's total good exports goes to the US, which means that a significant part of that is to other countries. So when you look at the picture from a purely goods perspective, it's not a very significant part of our GDP. However, we still will have to work on reducing our trade surplus with the United States. What are the major or the top 5 items that we export to the US? Engineering goods, 17 billion. Electronic goods, largely smartphones. As you know, Apple is one of the largest exporters of iPhones from India to the US. That's about 10 billion. Gems and jewelry, about 9 billion. Drugs and pharmaceuticals, 8.7 billion. And petroleum products is about 5.8 billion. And then obviously there are other things like textiles and so on and so forth. But these are the top 5 merchandise exports that India exports to the US. So now that India has a $36 billion surplus with the US, how do we mitigate this risk? What can India do to reduce its surplus with the United States? Well, there are two things that India could import significantly from the US. One is defense equipment and the other is oil. But first, let's look at oil. So very interestingly, if you look at this table gives you data about the breakup of the share of each country from where India imports its oil. In 2024, for example, India imported 232 million tons of oil. Data for the first 9 months of financial year 24-25 that is available, we've imported about 177 million tons. And if you look at the breakup for the first 9 months, which is the latest data, you will see that the number one country from which India imported its oil was Russia at 38%, Iraq 20%, Saudi Arabia 13%, UAE 9%, United States 4%. Now what's very interesting was that if you look at the same data in 2022, what you will see is that in 22, India was only importing 2% of its total oil imports from Russia. And from 2%, that number has gone to a staggering 38%, which means that the share of Russia went up significantly in India's oil import basket. Naturally, because of the sanctions on Russia after the Russia-Ukraine war, India was able to buy cheap oil from Russia, and therefore it was quite evident and rational that India diverted a large portion of its oil imports from Russia, and the figure went from 2% to 38%. Back in 22, India used to import 9% of its oil from the United States. And from 9%, the share of the US fell from 9 to 4%. In fact, last year in 2024, it had almost fallen to 3%. So one of the things that we have done is that if, let's say hypothetically, India was to take its share of imports back to 9%, right? Which means that almost more than double its share of imports from the United States, and assuming that we buy oil at, let's say, $70 per barrel, that would mean that we would have to import almost $7.6 billion more of oil from the United States. And what it means is that at least 25% of that $36 billion surplus that we have can be mitigated by buying more oil and gas from the United States. Now, whether that share is at 9% or India decides to go even beyond 9%, clearly this is one tool that India has apart from defense, where it can buy more oil at the cost. Probably we may have to reduce our oil imports from some of the other countries like Russia or the Middle East and divert that to the US. The other thing that India can do is to negotiate a bilateral trade agreement with the US. And here I would like to really highlight that India is way ahead of any other country in terms of initiating negotiations on signing a trade deal with the United States. I believe that one of India's biggest advantages in the current environment is that India has not gone down the route of many other countries, like criticizing Trump and its administration or putting reciprocal tariffs on US imports. No, India has not taken a confrontationist attitude with the US. It has rather taken a more conciliatory approach, right? So instead of criticizing the US or putting retaliatory tariffs, India is focusing all its energies on negotiating a fair deal with the United States, where obviously there will be some give and take. As I said, that we may have to import a few goods from the US, and India has also, in the run up to the April 2 announcement, had proactively reduced custom duties on several goods that are imported from the US. For example, motorcycles, we've reduced duties from 50 to 40 and 30%, from bourbon whiskey from 150 to 100%, some telecom equipment from 20 to 10%, and more importantly, apart from other things, an equalization levy of 6% was reduced to zero. This equalization levy was put on several US internet companies. So for example, if you watch Netflix, or if you shop on Amazon, or if you advertise on Google or Meta, there was an equalization levy that India used to charge these companies, which India has brought it down to zero. So very clearly, India's actions were very proactive rather than reactive, conciliatory rather than confrontationist. And we believe that this is the more mature way of handling the situation, and India is way ahead of many other countries. In fact, there are some news reports that there is a possibility that the India and the US could agree on a trade deal as soon as by June. Now let's look at some of the important sectors where tariffs could impact some sectors, and this is also important from a market perspective. One of the areas where India has a very large market share in the US is in drugs and pharmaceuticals. Almost 40% of generics medicines sold in the US are manufactured in India. India is very competitive when it comes to generic pharmaceuticals. Now, luckily, on April 2, when tariffs were announced, pharmaceuticals were kept out of any tariffs. Having said that, subsequently, President Trump has said that he does intend to put tariffs on pharmaceutical products as well. As counterintuitive as it may sound, because one of the largest costs for a US citizen is healthcare costs. Healthcare costs are approximately 17 to 18% of US GDP. And by buying medicines from India, it actually helps the United States to keep the costs of healthcare much lower. However, it is quite possible that potentially we could see tariffs being put on pharmaceutical products. The CFO of Lupin, one of the leading pharmaceutical companies in India, in one of the interviews mentioned that the cost to manufacture 1,000 tablets in India is between $5 and $6, whereas the cost to manufacture the same in the US is almost $35 to $40, which is 8 times more expensive. This provides a clear cost leadership and edge to the Indian pharmaceutical industry And even compared to some of our competitors, and our closest competitor in this area could be China. China, as you know, has 54% tariffs. And let's say if they decide to put a 26% tariff on India, we are still relatively far better placed than China when it comes to drugs and pharmaceuticals. The second significant area of services exports from India to the US is IT services, right? India has created a massive leadership position in IT services and BPO exports to the world, and specifically United States is one of the largest recipient and beneficiary of this service exports. While US has not currently imposed any direct tariffs on IT services, however, there could be an indirect impact on the IT services sector due to rising fears of a recession in the US because of the uncertainty around the trade and tariff policies. IT spending could be slower, and decision making would mean that the order closing cycles could be far more elongated for Indian IT services companies. The third important sector is automotive. The US has imposed a 25% across the board duty on all autos and auto components that enter the United States. And we believe that India, while direct exports of automobiles to the US is much lower, there is a significant amount of auto components exports that goes into the US. And we could see that if these tariffs were to continue, then there could be some impact on the auto sector and the auto component sector as well. But friends, as they say, in every crisis is an opportunity, and this crisis is no different. There are threats and challenges, but equally, I think there are great opportunities. The threats clearly are a global slowdown, and that could mean that many export-oriented sectors could see a hit on revenues. Also, margins of export-oriented companies could be affected because of tariffs. As it happens in any buyer-seller relationship, it will really depend on how the buyer, in this case the US, and the seller, India, negotiate, or the companies in these two countries negotiates on various goods and services. How do you split the impact of higher tariffs? Clearly, it may happen that Indian companies may have to share a part of the higher tariff burden, unless obviously the products that they sell into the US, there is no other alternative, or they have the pricing power where they can completely pass on all the tariff hikes to the buyer. That we will have to wait and see, and it may be different for various companies and sectors, and that's something that will evolve over a period of time. However, there are also opportunities. As I said, India is playing this very smartly. We are working on a trade deal with the United States, and given the fact that the tariffs on India, especially compared to many of the other Asian peers where the tariffs are much higher, means that in several Indian manufacturing companies have a real chance to increase our market share of global exports, and that clearly is an opportunity that Indian manufacturers can seize. The other advantage is that with the expected slowdown in global growth, we've already seen a significant correction in oil prices. That is also to a significant benefit to the Indian economy, because India, as you know, still imports 85% of its oil, and lower oil prices could mean lower inflation and a lower trade deficit for India. So, dear friends, this is indeed a challenging times for the global economy, and India is no different. In summary, however, I would say that India is relatively far better placed than many of the other countries. We believe that India has a great chance to negotiate a deal with the US. Our tariffs are much lower than our Asian peers. The benefit of the tariff challenge is that it will force every country and every government to look to stimulate their domestic economies in order to deal with the adverse impact of tariffs. As we've seen, China is talking about a massive stimulus to expand domestic demand so that it can handle the impact of tariffs as a result of lower exports. Europe, as you know, is talking about a massive expenditure on defense. I believe that this challenge will force every country, including India, to look for mitigating factors on how it can stimulate growth within the country. And I would believe that in these uncertain times, Indian companies and entrepreneurs, like in the past, have shown significant resilience and have adapted very rapidly. And that gives me great confidence. We have seen several crises in the past. We've seen COVID in 2020. We've seen the global financial crisis in 2008. And in each of these situations and many others, the Indian economy and Indian entrepreneurs have been seen to be very resilient and adaptable. And that gives me the confidence. I would also urge all of you to look at the YouTube video put out by Shekhar Gupta of The Print, where he says, "Thank you, Trump, for putting the tariff gun on India's head." What he intends to say is that India has always reformed whenever there has been a crisis, starting from 1991 up until COVID in 2020. However, the difference this time, like it was in COVID, was that instead of being reactive, India is becoming very, very proactive. And finally, the reflection of this is clearly seen in the performance of the Indian markets since April 2. If you look at the performance of various countries and stock markets, you will see that from April 2 to date, China markets are down 14.5%, Japan is down almost 13%, Germany is down 12.3%, the US is down almost 11%, UK similarly at 11%, Taiwan is down 10%, Vietnam is down 8%, Korea 7%, India is down just 5%. So you can see India has massively outperformed both developed as well as emerging economies. Similarly, if you look at the MSCI Developed Market Index, which is the index of all the developing nations, that's down 10.6%. The MSCI World Index, which includes every country which has a stock market, which is down 9%. MSCI India is just down 2.2%. So clearly, India, in relative terms, has shown far more resilience. Yes, in a globalized world, everybody would get impacted, but we believe that India is relatively far better placed, both from an economic perspective, B, it's way ahead in terms of very maturely managing the trade crisis by not having a confrontationist attitude with the US. And third, we believe that in relative terms, India will still be seen as a country with far better growth prospects and the lowest impact of tariffs. Dear friends, yes, these are challenging times in the markets, but as we have seen in every crisis, investors need to be calm and confident about India's prospects. As they say, this too shall pass. So with that hope and optimism, I wind up this month's communication until next time. Thank you.